Well, today the German cabinet approved the country's 2011 budget. Germany trying to lead Europe by example, tackling its federal budget deficit. Some say, though, its debt-controlling efforts are too aggressive. We partner now with the FT to bring you Lex on Bloomberg. You get a sneak peek at the Financial Times' flagship column a day early. Sarah O'Connor is joining us now live from London. Sarah, a lot of people are questioning why Germany has to be so aggressive because their economy looks pretty good, doesn't it?
Yeah, the German economy has actually had a great run of it recently. Unemployment has been falling for 12 months in a row. Economists are busy upgrading their GDP forecasts for this year. They reckon about 2.5% now the economy will grow. That's at least a percentage point more than the rest of the Eurozone. So yeah, Germany's economy is really looking quite good, particularly when you look at some of the worrying signs we've seen elsewhere.
Talk to us a little bit about some of the elements. I mean, is it exports? Are they tracking better than normal? Is it that factory production and manufacturing is doing well? What are the strong underpinnings?
Yeah, exactly. It's very much about exports. I mean, Germany has always been a sort of stellar exporting country, and it's really just benefited from a lot of restocking. Companies around the world that let their shelves go kind of empty during the recession have been making lots of orders to German companies to restock them. As well as that, the euro, of course, has been really, really weak this year. It's down about 10%. So that's made German exports in particular really quite competitive. So yeah, exports have seen a huge boost, and that's done great things for the economy.
Sarah, in your reporting, I mean, do people say that the strength for Germany is going to continue even with the austerity measures that are being passed?
Well, that's really people's big question now, and I think, to be honest, probably not, or at least not at the rate that it's going now. There are two worries, as you say. There's this question about the austerity package. It's pretty aggressive. It's worth about 80 billion over the next 4 years. That's spending cuts and tax increases. German domestic spending isn't really that great at the best of times, so that could have an effect. The other real worry is that there are signs that global growth is slowing in places like China, the US. I mean, that could really damage Germany's export-led recovery as well. Just
Sarah,
today, we had some signs that...
Sarah, we have to leave it there. We thank you, though. Sarah joining us from the FT.